And for those that submitted, I will say thank you. You've actually done well. I promise that I'm going to run us through the solution to that. I'll use the next 5 minutes to run us through that. And some people actually did exceptionally well. I don't want to mention any names. I have two like that. Just that they are not my gender. If they are to be my gender now, I would have shouted their names. All right. Opposite gender, well done. My gender also, you're well done. Yeah, please. I will want to run us through the solution. While I do that, let me present my screen and show us. I'll present my screen now. I'll be presenting my screen now. Please confirm if you can see my screen. One person is enough to confirm that. And for those that submitted, I didn't mark their script, sorry, or their assignment. The instruction is that we are to submit yesterday's evening. You are submitting by 12 a.m. or you're submitting by 10 p.m. No, my own evening starts by 6. So any assignment from 6 p.m. or 5:30 or so, I decided not to mark again. Yes. Sorry, it doesn't mean I don't want to mark, but you know, every one of us have one or two we're doing. We have a 9 to 5 jobs. Like me now, I just got inside. Nah. So, and we have other things we need to do also. Sorry for that. Next time, please submit early. All right. The assignment in one word, in 5 minutes. The solution. I'm trying to show, okay. Please confirm if you can see my screen. Is it visible now? Okay, Mr. Michael, how is it now? You should confirm now. By now, it should be showing. All right, nice one. All right. Thank you, sir. Okay, now you're welcome once again to tonight's class. Welcome, everyone. The first thing we'll be doing today, before moving to the main agenda for today, is to run us through the last assignment that was given to us. So it's a cheap one actually, and at the same time it's not cheap because but we've all done well. So the first question I have here is the one that says we should state which of the following item should be classified as capital expenditure for the purpose of preparing financial statement of financial position. And I explained the last time, I said capital expenditure. Someone actually like gave me the definition of capital expenditure, explained it to the point that you know the person is working in a public sector. He used the time they mostly use in public sector and some let me just say coordinated organization like that, capex, opex. He was using that. I was like, wow, nice one. Nice one. I think he's my brother. Thank you, my brother, for that. Yeah, you've done well, actually. You've done well. So, and for others also, I said I'm not going to mention names. We have a sister of mine. She did well, actually. I'm like, she explained them. She gave me the reasons why they should be classified as capital expenditure. But mind you, in an example, please just, this one is just for learning sake. Please just go straight to the point because you won't have the time. You might not even remember putting a reason why it was capital expenditure. So I pray God will be with us. Yeah, thank you all. The first question is saying state which of the following items should be classified as capital expenditure for the purpose of preparing statement of financial position. Just as simple as that. The first one is saying the purchase of leasehold premises. I want us through the definition of capital expenditure I gave the last time. I said capital expenditure. From the word expenditure means expenses. Yes. Expenses, what you expended, what you spent. Take it like that. Capital, those expenses that are capital in nature. That was when I was giving an example of an elephant project in Nigeria. I said some governments were back on a project, elephant project they call it. It's a capital project because an elephant project must be a capital project. That is a project in which the government has actually disbursed large sum of amount to execute. And it is not expected that the next government that will be coming in on power should embark on the same project again. You can't tell us someone just started a gold now and after 2 years, another government took over. And the next thing is doing is that same road again. Oh, no, the capital expenditure, the capital project is expected to last for, it's not even about more than 1 year. It should be last more than 1 year. I'm just saying what's it called? The threshold is that it should be a project that will last more than 1 year. That is, if you expend that kind of money today, you're not expected to spend the same amount tomorrow on the same purpose, or in the next 12 months. Oh, the same thing we want to do again. No. So the first one is saying the purchase of a leasehold premises. Leasehold premises can be termed something like a building, an office space or something. You purchase an office space. I think I cited an example, something like this. You purchase an office space. Are you going to term it as a revenue expenditure or capital expenditure? It's going to be a capital expenditure because it's capital in nature. Especially when you come to Lagos and you rent house. You went to Ajabi, Ikoyi to rent office space. And you are telling me to not capture it as capital expenditure. When you are renting an apartment in Ikoyi for more than what's it called, 20-30 million. It's capital. That's capital in nature. So you have to capitalize it because the asset that you are acquiring is expected to last for more than 1 accounting period. Yes, that's great. So for that reason, it will be captured as what? It will be captured as a capital expenditure. That means number one is what? Capital expenditure. At the front, or just write it one. Project of clinical, or you can just classify them capital expenditure, revenue expenditure, number one. Let me look at someone's book. Capital expenditure, revenue expenditure, and then you classify as such. So it's as simple as that. That is number one. Number two. Sorry for this. Yeah. You can see. Okay. You can see this. The purchase of leasehold premises. These are the answer. Okay, this is not even the one I'm looking for. Okay, this one is one of the ones I'm talking about. Nice one to the owner of this. Let us just go to. All right, not to waste much of our time. Let me just do it the way I'm doing it. Okay, the first one is capital expenditure. If you know you got it wrong, or you get it wrong any which way, please correct that in your book. The first one, purchase of leasehold premises, is capital expenditure. Number two, the annual depreciation of leasehold premises, meaning that depreciation is the reduction in the estimated useful life of an asset. That is a reduction in the useful life of an asset. And depreciation is something you what? It's an annual depreciation, annually, 12 months. And even before you get to 12 months, a depreciation is something that reduces the value of the asset. That is, some organization or some software, instead of computing the depreciation at the end of the year, what they do is that they charge it on a monthly basis. In this year, this is the portion of depreciation. And at the end of the day, they accumulate everything at the end of the year. So annual depreciation at the end of the year is not a capital expenditure in nature. This is not an expenditure that is capital in nature. So it will be captured as what? As revenue expenditure. So because it is something we do annually, that is, it is not more than 1 year. It is something we do annually. So it will be regarded as what? It will be regarded as revenue expenditure, not capital expenditure. I'm talking of number two. Number three. You know, I'm not doing only capital expenditure. I'm doing both capital and revenue now. So the first one is what we need as capital. The second one is revenue. What the third one says, solicitor's fee in connection with the purchase of leasehold premises. Yes, this is. I remember I was saying something about capitalization when someone asked about tire. I said anything that will increase or improve the useful life or extend the life of that asset that you are buying. What will you do? You capitalize it as such. That was when someone was asking me about, hey, it was tire now. So and I said, as far as that tire is, it improved the life of the car. That is, even if it's going to give it an extra tire, fine. It still improved the life of the tire of the car, rather. So you capitalize it. So solicitor's fee. Solicitors are like, you have a lawyer here? Sorry. something like, oh, you engage someone like, oh, I wanted to buy, okay, I'm planning, this company is actually planning on buying a building located at number 27 Ikoro Road. Yes, as my lawyer, I needed to go there to value it, to see if the price they're giving me for this building actually worth it. Can I go ahead and pay? Are they the true owner of this asset? So all this information, solicitor will charge you. So all those charges, all those costs will be added to the initial cost of the asset. That is what capitalization is saying. Because, so let's say now the building now was 10 million and you pay your solicitor 1 million, you're going to add it to the cost of the building. So that makes it 11. That makes it a capital expenditure. Because if you incur that money today, your solicitor will not come back tomorrow and ask for another money, or will come back next year, except you are acquiring another building. So if he gets the money now, it's not coming back next year. It's not an annual payment. It's a one-off payment that will last. Once you've paid him for the service he rendered on the building, it's gone. Put it on here. Based on that, it's a capital expenditure in nature. The third one is the cost of adding extra storage capacity to a mainframe computer used by the business. Look at this thing, a cost of adding extra storage capacity. The storage you are adding this year, are you adding the same storage next year? No. And again, what is this storage going to do for you? It improves the efficiency of the computer. And I said, those are the threshold, those are the things you need to take note when you are capitalizing a cost. Oh, this cost, what is it adding? What value is it adding? What value is it adding to the business? Oh, increasing or improving the efficiency of this computer, which means if I should improve it today, if the asset is meant to use 2 years before, because of that improvement that I've done, it could lead the computer to spend additional 2 years. For example, my phone, let's assume I'm using an Infinix, or let's say I'm using a Techno phone. So the phone fell and the screen got broken. I went to an engineer to repair it. No. At the point where the screen is bad, if I want to sell it, someone priced the phone for 10,000. Okay. I was like, okay, 10,000, I'm not selling. So I went to Computer Village to repair the screen. I got a new screen for 5,000. Are you with me? I got a new screen for 5,000. That new screen, I'm not expected to repair the screen in the next 1 year. We know how we can use phone, we can even swear the following day. But on normal time, it's not expected to incur the same expenditure on this for the same purpose the next year. So let's say I'm getting the screen. What has the screen done to my phone? Improve the useful life. With the screen that was bad before, I can let me say I can just manage to use the phone for the next 6 years. 5 months or 4 months. No, 4 months. Okay, for 2 weeks safe, because the screen is bad. So now that I've changed the screen, it's improved what? It's improved its useful life. Those are the things you need to take into consideration when you are doing this classification. All these classifications are needed eventually when we get to the preparation of financial statement, because they are those things we call recognition criteria of asset and liability. We'll get there. Don't let me be rushed. So the next one is saying computer repairs and maintenance costs. The maintenance cost is something you do frequently. So it can't be a capital expenditure. You might repair one part of your car today and tomorrow another thing will still happen. You can repair the screen of your laptop today and tomorrow and they tell you to service it again. You still have to do it. All those computer repairs, maintenance is something you do frequently. Even there's some laptops that they go for servicing every month, or there's some generator every month they must service it. So that one is not capital. So profit on the sales of an office building, it's a profit on the sales. When we're talking of expenditure, this one is talking of what? This one is an income. Profit on the sales of office building. Profit. You don't need to add it. I saw someone adding it. I was like, how? As how? Profit. We're talking of expenditure. We're talking of profit. The Lord is your strength. Okay, revenue from sales via credit card. All these ones are income. We're talking of expenditure. That is expenses. The money the company spent. All these ones are income. So the cost of new machinery procured A machinery can be termed as a plant and machinery or generator. All those things are the things that falls under machinery. The cost of new machinery. Let's say the cost of generator procure. Procurement means you buy it. It's still the same thing. You went to buy, you went to procure. An English word. So everything now this one, our cost of new machinery procure is the capital expenditure because it is something you went to buy. It's like you buying a new generator. You're not expected to like, oh, the money you went to use to buy this generator is not expected to be incurred the next month, except you have another branch you want to get a generator for, but for the same purpose. No. So cost of new machinery procure will be treated as a capital expenditure. Custom duty charge on machinery procure and imported into the country. Custom duty, those are the costs associated with the purchase. You have to capitalize it also. It will be treated as a capital expenditure. The carriage cost, because once you incur the cost today, you pay the custom duty or whatever they call it. They're not going to come to your office tomorrow and be asking you for custom duty again. It has passed border, it has passed with that. And if you find your way to bring it in Nigeria without paying, so the carriage cost of transporting new machinery from the supplier's factory to the buyer's premises. A carriage cost of transporting new machinery. You see all these costs you are incurring at the installation. I said something about installation costs. All these costs you are incurring, they will be added to the cost of the item, because carriage cost of transporting new machinery, it's just a one of something. It's a carriage cost of transporting new machinery. Except you are getting another machinery before you pay that money again, before you incur that cost again. So the wages of machine operator, wages, even if it's salary, it's something you get what? Is it that wages is either monthly or bi-monthly or 2 weeks or I don't know other word I can use. So it is something that comes frequently. You'll be incurring it. A staff will continue, the operator will continue getting his salary every month. I mean, you, because of the company, well, I trust my people, they will collect their money no matter what. So the wages is something that comes frequently. It's we call it recurrent expenditure. It will keep coming. Recurrent expenditure. That's another word. So cost of cleaning of the machine room. All these ones are recurring expenditure. We will keep cleaning it. Especially when you're using a machine that is leaking oil, you will keep cleaning them. You will keep paying. So all those ones are just recurrent expenditure. They are not capital in nature. Cost of all another material purchase for the repairs. All these ones are recurrent something. It's something you do. If you are the one that services your generator every month, you keep incurring this cost. So that's that about that. So this one is saying the relation between cash, accrual, and breakup basis. This is just straightforward. I love everyone that has actually answered this question, just for the fact that I have some people that want to use, is this ChatGPT or what do you call it? Please, it will be so obvious because the way you explain, the term you use are not a layman word. Please, you will not have the opportunity of using all this in exam. But the important thing is that I saw someone's definition and I was like, wow, I love this. You know, it's based on what he or she has written in the exam. In the tutorial class. Based on that, and she actually explained in her own way, based on her own understanding. That kind of explanation, it's not possible for her to forget. Even if she's going to forget, she will still remember the keywords that she has used. So it will happen on the exam. Yeah, we're not marking based on grade. I'm not grading anyone here, but the one that will grade you, it's based on what you've been doing. Thank you for that. So I love all the explanation everyone has given on cash, alcohol, and I'm not going back there. Yes, we understand that. I see most people got like they explain it well. So the only thing I'm going to talk about is setback. This setback, someone explained something. I was like, this thing that you went to Google site, can you even explain it yourself? I'm not going to mention him, but please, when we Google search something at the same time, try to understand it. So one setback, let me give us 2 or 3. Number one is that they're saying with cash basis. What do we explain cash basis? We say cash basis that is cash basis of accounting is used. That is when it's sorry, what am I saying? Cash basis are when transactions, events are recognized when cash is paid or received. That is, they only record transaction when it involves the payment of cash or receipt of cash. Simple as that. So meaning that what are the setback? One of the setback is that, I said something the other time. I said it's a cash basis, meaning that if any customer is owing you for prior year, you will not take it into consideration. That means it will not be showing the true picture of your financial position at the end of the day, because there will not be provision for receivable. There will not be provision for payable. Payables are those people you are owing, while receivable are those that are owing you. There will not be provision for that. What you will only record is what comes in. If money has entered, we record that. The money no enter, we know they record. That. It will not show you the true position of your business operation. That's one. Another thing is that this one doesn't match costs with revenue. That is actual cost that was incurred and the revenue that you are meant to have recorded. I saw this item. I'm here to collect money. You have to recognize the revenue and make a provision for the receivable that these people are actually owing me. So whenever someone asks you like, what is the total turnover for this year, they can tell you it's 10 million. Not you recognizing, the only money that enter our bank account is 5 million, and that is the revenue. No, because there has been a provision for receivable people when you, and also you owe some people. There will be a provision for that also. So that one will not show, it will match revenue with cost. But I mentioned two now. Let me come again. One of them is that it does not match revenue with cost. Number two, it does not show the true position of the business organization. I'll explain that further in the sense that it does not make provision for what? Payables, receivable. And I have explained payables and receivable. And again, on-hand income and liability accounts are not reported because liability are obligation on the company. When we're talking of obligation means debt. And I have said that I'm only recording it when I pay or when I receive cash. Liability means that I'm owing someone. So it's one of the setback. It does not record liability and on-hand income. Are we together? Let me come back to my people. All right, thank you. All right, so we can proceed. We're spending much time. I wish to end this assignment by 9. So I'll be fast now so that we can meet up. So question 6, I think I've mentioned like 3 for that. So question 6 is saying given below the item of revenue and capital expenditure. Yes, this one is now saying capital and revenue expenditure. I think I only have 2 or 3 people that got all the 8 right. I mean the classification. You got it well. Why I have 6, I have 7, I even have 3, please. So the thing is, based on what we explained, based on the explanation we gave for question 4, is the same thing we're going to use for this. One is saying a number of new cars that had recently been cleared by a motor car dealing company. Is that my speaker or someone? Okay. A number of new cars that has recently been cleared by a motor car dealing company. A number of new cars that has recently been cleared by a motor car dealing company. This means this company we're talking about, what they deal with or what they do is that they sell cars. These cars in question are their stock, or we call it their inventory, which means that their inventory are something they will have to be procuring as they make sales. Meaning that they might clear 5 cars today or 20 cars today. Next month they might clear another one. Upper month they clear another one because it is their inventory, it is their stock, it is what they sell. Meaning that it is the same thing that is applicable to someone selling sweets. You bought 10 sweets today, You finish selling it, you went to the market to buy another one, to buy another one, to buy another one. All these transportation costs, everything, you keep incurring them. They are recurrent in nature. Definitely, they are not a capital expenditure. It's not a cost you incur that until next year or next 2 years before you incur it again. They are inventory. A number of new cars is going to sell them. Recently cleared by what? A motor car, it's like an inventory or a stock to the company. So it's a revenue expenditure and not capital. So number two, two new motorboats acquired by a ferry service agency. They said there are two new motorboats acquired. That is, they bought a new boat. That means it's an asset. What kind of asset is that? It's a non-current asset. It's like a company acquiring what do they call this motor? Okay, let me just use any word. So it's like a company that just acquired a delivery fan. A company that does distribution, they just acquired a delivery. It's an asset to them. It's a non-current asset, which means that they are not going to incur the same amount again because it's a non-current asset and it's expected to last for more than one accounting period. So that's the capital expenditure that they've incurred. Please, as I'm trying to be fast. If you have any question based on what I explained, please let me know. In the comment section, just raise your hand, or you raise your hand. Once I come back there, I'll answer that. That's number two. It's a capital expenditure. Number three, they said vacant houses used by an estate developing company in respect of which negotiations are ongoing for assistance for their sales to what? To prospective landlord. Vacant houses owned by an estate developing company in respect of which negotiations are ongoing for assistance for their sales to prospective landlord. This is a developing, what do they call them? Developing, what do they call these people? Developers, sorry. They said a vacant house it's not an asset it's not an asset to them. And I gave an definition of assets yesterday. I said they are assets, they are resources owned and controlled by the entity. These people do not own it. They do not control what happens in these vacant houses. They are just a developer. That is why they say negotiation are still ongoing for assistance. Like they just want to help them and get their own commission. This is not a capital expenditure. It's a revenue expenditure. New buildings acquired. When you're seeing anything acquired, building especially, any asset acquired, they are capital expenditure. Don't let me go far on that. Whatever they use it for. New buildings acquired for the purpose of holding the item of plant and machinery belonging to a detergent manufacturer. Any person that tends to like acquire it, it's a new building acquired. It's an asset. It's a non-current asset. So it will be captured as a capital expenditure. Cost of acquiring a leasehold property for office use. That's obvious. It's a capital expenditure. Granite purchased by an engineering contractor for use at a construction site. It's a granite purchase. Fine, they purchase a granite. Is it something that can last? Once they finish it, they're going to buy another. It's a revenue expenditure. Cost of rehabilitating a dilapidated housing unit owned by an estate developer. It's a cost of rehabilitating, cost of renewing, cost of improving the building. All these big word. Cost of renewing. Oh, they paint it, they did this again. It improved the life of the assets. They said owned by an estate developer. Owned, that means he owns it, he controls it. It's an asset to him. It's a capital expenditure. The last one, repairs to plant and machinery in the manufacturing company. Repairs, we've been talking of repairs so many times. So that's a revenue expenditure. So thank you all for those that actually got everything right. We really appreciate that. So today we'll be going into the main class of today. And find this material again. Oh, I believe by now we should all have downloaded our material. Someone asked me the last time, how do they use the past question guide? Sorry, after this class, I will want us to know how it's meant to be used. Well, before then, please let's do something. So we've actually finished chapter 1. We're moving to chapter 2 of this our gigantic material. I want to believe that we do not have question as regard what we've explained so far. And person with their mic, please. Okay. All right. So I want to believe that we don't have any question. Lucy is raising and please just type your question here. Some of us just joined today. We don't have the study guide. Okay. For those that just joined, I will share everything to the platform. So that's not a problem. Oh, Lucy, you're raising your hand. If you have question, just type it for now. If you do not have question and you mistakenly raise hand, please unhand your hand. Unhand your hand. So we're going to chapter 2 of this material. Chapter 2 is what we call the IASB conceptual framework. Yes. Please, last class, I gave us the meaning of IASB. Can someone just tell us, make it echo? What does IASB mean? All these things are just something we should know by now.
International Accounting Standard Board.
Thank you. Thank you. That's okay. Thank you, everyone. So we're going into the conceptual framework. The word conceptual from the word concept. Just put it like that. From the word concept. That is ISB concept. Framework and those things that guides you in the preparation of what? In the preparation of accounting. There are those things that let me just say there are those guidelines that has been laid down by International Accounting Standard Board to ensure that accounts of financial statement are being prepared in accordance with the relevant rules and regulations. That is why no one can just say, oh, it's accounting. You can prepare account, I can prepare account. Just do it like this, Darren, but just get how much we're going to spend at the end of the day. No. It's about taking into consideration people that have actually invested their money in that business so that they will not be misled or they will not be misleaded. Which one is right? So that they will not be misled into putting their money into a business that is not properly managed or they do not take into consideration relevant standard or framework guiding the operation or guiding the operation of their finances. Yes. So we're talking of one of the most important things we should take note as far as conceptual framework is concerned is the gap. Gap is one of the principles or one of the rules or guidelines guiding the preparation or preparation and presentation at the same time of what? Of financial statement. So this one is talking about this one. Okay, they have gap here. What do you mean by gap? Gap means generally accept. I'm giving another acronym. All those acronyms are something we should buy now. Flow. So gap means generally accepted. It's accepted. Yes, generally accepted accounting principles. Look at the word generally accepted accounting principles. That is, they are accounting principles that are generally accepted for the preparation and presentation of financial statement. You see, I kept adding presentation. When you prepare, you present. Presentation in the sense that is from the word you're presenting a PowerPoint. Fine. For what purpose? For explanation purpose, guiding purpose. Interpreting all the figures you've actually sum up in your financial statement, presenting it to the board, presenting it to the users. Oh, this is what this means. We have a total non-current asset of this. This is our working capital. How do you get your working capital? Oh, this is the total current asset we have minus the total current liability we have. It gives us the working capital. Working capital is what we use to run the day-to-day running of the business. Okay, this is our liability and then we have a short-term liability which is made up of the loan that we got from so we have to pay interest of so on this. This loan is being used to finance this. This is what we are accepting on this loan. All those are what you are presenting. You are presenting the financial statement. It's a jargon to whoever that is not an accountant looking at it. They are just a mere figures. They are what? They are just a mere figures. But with your explanation, with your presentation, in a manner that you've disclosed what needs to be disclosed. the user will not have any problem. So when we're talking of gap refers to, okay, let me give something so everybody can write down before I go on. Generally acceptable accounting principle, they refers to a set of accounting standards, principles, and procedures that are used by companies to prepare and present their financial statements. I'll come again before the definition goes. So I said they refer to a set of accounting standard, principle, precedent, and procedures that are used by companies in the preparation and presentation of their financial statements. So what we're saying now is that that encompasses principles, laws, regulations, that guides, that underpins the preparation of financial statements. You don't just prepare for your financial statement based on, oh, maybe to add this plus this. No, it's about knowing what guides this. Oh, this company actually wants to pay dividend. What are the regulations? What are those laws that guide the payment of dividend? And then when they are making loss, what does the standard says about it? It's about you understanding it. It's not about presenting the figures only. So we're saying preparation and preparation of financial is based on a large number of concepts, principles, and detailed rules. Some of these are contained in laws and others in financial reporting standard. Fine. So financial reporting, they are the standard that guides the preparation. This is what this one is saying. They are just standard that guides preparation of financial. There are so many standards. And we've been listing them. So we're saying that they are the concept, principle, convention, laws, regulations that are used to prepare and present financial statement. Each of the countries, or let me just say, each country in the world, majorly they have their guidelines, they have their principle. So the ones that are notable are the US GAAP. We have, you see, they said, for example, there is US GAAP, there is EAU GAAP, there's UK GAAP, there's Nigerian GAAP. So I will be saying that, yeah, I say we have GAAP in Nigeria. We do. What we adopted in Nigeria are the IFRS and the IAS in Nigeria. Are the IFRS and the IAS in Nigeria. That is what Nigeria adopted. That is what we adopted. They say Nigeria, in common with other countries, have adopted international financial reporting standard, which means IFRS, sometimes called international accounting standards, IAS. So that is what we've adopted in Nigeria. So not to waste much of our time. So we're talking about conceptual framework. We've explained this on the side that the concept that underpins the preparation of an statement. And this ones we've explained this. So, and again, when we're talking of this concept, you should bear in mind that what they want to achieve, or what they are here to do, is to ensure that the purpose of financial reporting is being met. The objective, why are we really preparing this thing? Then qualitative characteristics of useful financial information, financial statements, and the reporting entity. All these things are just what all these principles they came to explain to us, that you should have bear at the back of your mind, like in preparation of financial statement, all these things must be taken into consideration. Yes, so it has its own purpose, which we can actually, it's like you saying, they said there's no sin. What's this proverb? There is no where there is no sin, where there is no law, there is no sin. Yes. So now we have laws, we have principles that guide preparation. Meaning that if there had not been these guidance, I call them guidance because they are something that guides you in the preparation for assessment. So if there had not been these things, people would have been, oh, just treat this item anyhow, just do this anyhow. That is why you'll be seeing people say you are not preparing double entry in your company. No, it's single entry. People are doing. So people can just choose to, like, oh, one day stand up, the owner of business can be like, oh, I'm selling generator, carry 5 to my in-laws, just share it to them. the inventory of the company. No, you don't do that. You don't do that, because one of the concepts that this thing brings about is what we call entity concept, separating the owner of the business from the business itself. Oh, it's your business, I will know. But you should understand that the public, the people, investors, they have stake in that business also. Everyone has stake in your business. So the fact that you are the owner of the business doesn't mean you can just decide to squander the money anyhow. No, you don't do that. You are not allowed to do that. You started, Abby. Generally accepted accounting principles. Yes. Okay. Thank you for answering that. Mr. Adebiyi Abdul Karim, do you want to go out? Maybe I should remove you. Thank you. All right. So I can continue. If I'm being too forward, please, you can call me back. Just guide me back. I'll come back. So all these things are just boring notes. But at the same time, it's better to go through them for the purpose of basic knowledge. So, and for the purpose of theoretical aspects and objective. So so now this conceptual framework is telling us about the users of financial information and their informational need. And I believe we've done this yesterday. For that reason, I'll be skipping this. Users, we've done this yesterday. Informational need, the reason why they need them, we've done that. So the next thing I'm moving into is the objective of the general purpose financial statement. Why do we need financial statements? I want people to answer. Oh yeah, I'm waiting. You want me to call names? If you want me to call names, okay, not to waste much of our time. I'm not going to call names actually. Can you come in? Meaning you are not following me. Thank you, Yusuf Nagat. I'm going to give you names soon. All right. You said I should come again. I was asking, like, the purpose of preparing financial statements, which is what we've actually stated. We've explained so much things about that before. So I'm going to give us, to make this thing faster and not to waste much of our time, I'm going to give us some purpose of conceptual framework. I'm going to give us purpose of conceptual framework, and I want every one of us to write now. One of the purposes is that it eliminates the problem of inconsistency in the preparation of financial statements. I'll come again. It eliminates the problem. I'm giving us the purpose of conceptual framework. Why do we even need this conceptual framework? Number one, it eliminates the problem of inconsistency in the preparation of financial statements. I will explain that now. When we're talking of inconsistency, one of the concepts of accounting, I don't want to jump. So please just write this thing down. You just got it. There's something accounting we call concept and convention. We call it concept and convention. Accounting concept and convention. Yes, accounting concept and convention. When we're talking about accounting concept and convention, those are the rules, they are the principles that guide the preparation of financial statement. Rules, convention are rules and regulations. Concept are principles, standard that guides preparation of financial statement. So in accounting, we have this concept and convention that it falls under this conceptual framework. So I always do something for my students while listing this, because it tends to be much. I'm going to mention this now. Something is like, let me just say, is there an acronym I should call it, or like a short code that will help you anytime you see question under concept and convention, it should just ginger your memory once. So when we're talking of concepts include, before I actually go to, when we're talking of concepts, you should bear in mind that the whole of concept falls within what we call chapek. I call it chapek, and I'll be picking them one after the other. Chapek. This is something that helps in exam instead of you, because concept itself is like 1, 2, 3, 4, 5, 6, like 7, conception is like 5, something like 12. So that you not mix them together. In account, in why I can is asking question these days, they just ask you, this is the concept and convention. What are the accounting concept and convention? You can list them together. I'm just saying for knowledge sake. The concept and convention, concept itself, the concept there are the chapek. I'm going to list them now. The C in the chapek stands for consistency. So that was what I remember before explaining the purpose of a conceptual framework. That is, it eliminates the problem of inconsistency. So what is consistency telling us? Consistency concept is telling us that in the preparation of financial statement, whatever method or whatever principle you've actually adopted in your presentation, you must be consistent with it, with the word consistency. I'm looking for similar word for consistency. Someone should type in the comment section. You said I should spell it. Okay, I should spell consistency. 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 That's consistency. Consistency. Consistency, the C stands for what? Consistency. That is, for example, I'm a company. So I've adopted using a straight line method for my depreciation. Sorry, I'm going, for those who have not heard about types of depreciation before, or method of depreciation rather, there's so many methods. We have straight line method, we have reducing balance method, we have some of the year digits method. We will still go there. You don't need to rush. So I'm not saying no the acronym CHAPEG. CHARPEG. CHARPEG. That's CHAPEG. Someone is asking me about the acronym. That's it. So consistency. Let's say now a company, you're a company and you have actually adopted a method of straight line method of depreciation for your assets. You cannot wake up the following day and decided to change it to what? To some of the year digits. A straight line method is you saying it always be cost of the asset minus cost of the money and cost of the asset all over the estimated useful life of the asset. For example, if the cost of the asset is 20,000 and the asset is meant to use 4 years, it goes to 20,000 divided by 4 years. That's your straight line. But when we're talking of reducing balance method of depreciation will not tell you like, no, you do it like cost minus accumulated depreciation all over estimated useful life or unexpired useful life. That is some of the year digit method. So if you're the company that has adopted straight line, you cannot just wake up the following day or the following month. No, change this one to depreciation or use a straight line for this, use something for this. No, you have to be consistent. That is what this one is saying. Without this concept now, so many companies like oh, we want to, let's find a way to inflate our expenses. Okay, which one gives higher depreciation? Use it this year. Which one gives a lower depreciation? Use it next year. Instead, I should repeat the formula. Okay. For a straight line, you just use cost divided by the estimated useful life. That is straight line method of depreciation. For reducing balance method, cost minus accumulated depreciation all over unexpired useful life or estimated useful life. Anyone. So the C is saying consistency. Be consistent with the treatment of items. With the way you are treating your item in your books, be consistent with it. That is consistency. So the number 2 is H. H is what? Historical. Should I just list everything and come on account? Number 2 is saying what? Historical concept. That's what the second one is telling us. And number 3 is so that we can write and I will explain one after the other. Number 3 is Akura concept. Number 3 is Akura concept. Number 4 is R, Abi. R is realization. Realization concept. The next one is P. Periodicity. Yes, periodicity. Period. Like you're writing period. DCT. The next one is next E. E is entity concept. Entity concept. E is entity concept. And the last one is G, which is going concern concept. Going concern concept. So I'm going to pick the explanation from the last one I just mentioned, going concern. I want to believe that we've captured everything. Going concern. So I'm going to start from going concern. Going concern concept of accounting is saying, as a company, a business entity should continue to operate in the next foreseeable future without the intention of liquidating. I'll come again. Going concern that a company should be able to operate in the next foreseeable future, should be able to operate in perpetuity. That is, you should not start a business that you know next year you have to wind up because you don't have the capital, you know what it takes to maintain the business. For example, in Nigeria, over the I think 1950 something, it's about there's something we call the failure of banking era in Nigeria. Those are the period whereby banks in Nigeria are folding up. We have Aremu Bank, then we have so many banks that have actually folded up because they see banking operation as something they can do. Oh, we have money, we can give money out to people, we can extend loan to people, we can accept deposit, but maintenance costs, another cost associated with maintaining a banking operation is something they cannot cope with, and they never take that into consideration. So they just went into business, and then the business had to fold up, and so many people lost their money. So CBN come, before you can even start a banking operation in Nigeria right now, there's something we call what is all this monetary policy operation? Is it money? Yes, monetary policy that CBN gave. Is there must be a cash reserve ratio of 500 billion or so. Like you have to keep it with central bank. So if you at the end of the day you are planning to you are folding up or something, you must have enough assets that can pay people's money. For example, we have Access Diamond merge of recent. One company one bank, two banks like that. Access took over Diamond. Or Diamond took over Access. I don't know who took over. Okay, that Access took over Diamond. So let's assume that like that, Diamond just went. They just went off like that. And people's money is with this bank. What would have happened? But now there's an agreement whereby people using Diamond, they move to what? They move to Access, and their money is saved. Someone is saying they're confused. Lucy, you have the floor, please. Can I have a question? Lucy. You missed this one. Where do we need conceptual framework? I was given that, and I remember that we need to understand the concept and convention. That was when I went back to concept and convention. I'll still give us the purpose of conceptual framework. Are you getting it? The first one I gave was it eliminates the problem of inconsistency in the preparation of financial statement. And I was like, the word consistency, there is a concept. It's part of the concept of accounting, and we need to understand that. So I don't want to jump that, or I don't want to skip that before I forget. That was why I actually went to concept and convention. I'll still go back to conceptual framework. Yeah, thank you. So, not to waste much of our time again. So, going concern is saying a business should be able to operate they should be able to operate in perpetuity. They should not have in mind of winding up, closing business next year or any foreseeable future. That is, they should be able to stay in business for a long period of time. So that is what that is explaining to us. So I'm picking it from the back of it. Okay, entity concept. I've been using entity concept for so much time now. Entity concept is saying that the owner of the business is different from the business itself. That is why you cannot say, oh, I bought Dangote cement. When I opened it, I discovered that the thing has is it fog or module up, and I could not use it. A cement is meant to be some form of, is it dust or what they call it? So when you now buy a cement, you discover that it was a major. Okay, Access Diamond, it was a major. Thank you, sir. So they said Access Diamond, they didn't mind. We're just trying to explain. I'm not saying that either they merge or they want. I'm just saying, explaining to us, using it as an explanation altogether, that they should be able to operate. Even when you merge, there must have been a reason for the merging. So let's not go there. Okay. Someone said it's an acquisition, not merge, or anyhow, please. If it's acquisition, if it's merging, please let's just go. Let's just go on with our own class. All right. So entity concept is saying Dangote cement. Oh, okay. I don't want to use the word Dangote. What product should I? We all know Yale biscuits. Oh, Yale sell, they're the owner of Cabin. So I bought a pack of Cabin. I bought a pack of Cabin biscuit. When I opened it, I discovered that instead of having biscuits inside, I discovered that I was seeing something else inside. All the biscuits, I found cockroach inside the biscuit, and I paid for it. So the next thing I did was, oh, call my lawyer, and I went to the owner, the CEO of Yale Biscuit. I went there to like sue him directly, or I took, oh, police officer, or someone actually consumed the biscuits and it led to, let's say, a death or something. So the next thing I did, oh, you carry police. Next thing you went to the owner of Yale and you went to arrest the man. Is it possible in Nigeria? No. Is it possible in accounting world? No. It's not possible in a finance world, because we're saying this. We have concept that guys, presentation, the whole of the financial operation, the whole of the operation of a business. They're saying anything concept is saying the fact that I am the owner of this company you do not have the right to come and arrest me. My business is a separate entity, different from I, the owner. That is, you bought a biscuit last week. This week you saw that it has expired. You cannot come and arrest me. You will sue the company itself. Oh, you can only sue Dangote itself, not the man himself. I don't think someone is getting me. You can only sue Dangote as a company for his product that went bad or for his product that caused problem. You cannot sue Aliko Dangote, the man himself. That is entity concept. The same way you cannot sue them, they are a separate entity. The same way you cannot do that is the same way Dangote cannot go into that. Aliko Dangote himself cannot go into Dangote Cement accounts, bank account, and withdraw money to pay for his daughter's school fees. You see, the same way you cannot call Aliko Dangote for the liability of Aliko Cement. Dangote Cement. It's the same way Dangote, because he's a director. He cannot just go there anyhow and be withdrawing money. Or, oh, this is the company's credit card. You gave it to your daughter. Go and die in Canada. It's not done that way. Entity concept is you need to protect the stake of investors, the investors, everyone that has stake in the company. Their interest must be protected. That's entity concept. So, which one again? Periodicity. I said I'm taking it from the back. GEP. Periodicity. Periodicity. From the word period. Accounting is prepared periodically. Accounting is prepared periodically. This one is simple. So accounting period or accounting time is for a 12-month period. A 12-month period. If you're starting in January, the period ends when? Ends in December. That is why you'll be seeing most companies saying for the year ended as of December 31st, 2024. As of December 31st, 2020 something. Because it's a periodicity something that has period. and it's a 12-month, mostly 12-month period. There are some companies that will prepare their period, they are preparing their accounts will prepare their account on a quarterly basis. There's some quarterly basis, especially those PLC. They are meant to report their accounts on a quarterly basis, unaudited financial statement, quarterly basis. That's another aspect. So 12-month period. Periodicity, there's a period for accounting, which is mostly 12 months. So that is what that is telling us. So this is also part of the concept that you cannot just say, before I can prepare my financial statement will be until I've traded for 10 years, 4 years, 5 years, I will not merge everything together. No. Even if you've not been preparing your financial statement for the past 4 years and you want to prepare it, it will still be prepared on a period base. That is, you prepare the first year, the second year, the third year, the fourth year. So that is what periodicity is saying. The next one is realization. I think I've explained that. So the next one, which one do I have again? ACTI. I'm not going to explain ACTI again. I've explained that. We explained that in our last class and part of the assignment. So we're trying to cut time. So if you don't understand, just have I explained realization? Have not.
No, sir.
No, okay, realization. Thank you. So when we're saying realization, this is relevant, especially when a company is having problem with its going concern. For example, a company that is facing liquidation and they wanted to close up. So, or forced to actually sell their business. There's something in accounting we call bankruptcy and executorship or liquidation. There's an account called liquidation account. When the company is about to wind up, realization, how much are we going to realize on our asset as at this time? That is the concept they use. Oh, this moment that we're going to wind up, how much are we going to realize? Something like a breakup. They want to break up. So they want to wind up. It's the cost they're going to realize as at that moment. Oh, they are having financial difficulty and we have an asset that we can actually dispose. How much are we going to realize on this asset that we're going to sell now? To what? To recoup, to stand back in operation. So ACTI is next. I've explained, sorry, I didn't explain that, but I know that we know that because I believe I trust us. Someone is listening and before. Let me have your observation. Is your observation a question? It's what I don't like. Okay. Historical. When we're talking of historical, this refers to the original amount. Should I put this? Okay, this refers to the original amount that an asset is being acquired in a company. That is, that is why you always see company showing the cost of their assets. How much does this thing cost? Historical, it has happened in the past. It's a past tense. What is acquired basically same as accrued expenses? No, I will explain that, but let me finish this explanation first. So, historical cost is saying that the original amount of money paid to acquire an asset or what they receive in exchange for a liability at the time of acquisition. At the time of what? At the time of acquisition. It is part of the cost we have in accounting. We have historical costs, we have current costs. So let me go there. So that I've explained consistency. Now this is the concept. I want us to note that. So someone is asking, is acquired basis same as accrued expenses? What is the definition we give for acquired basis? We said events, transaction, circumstances are being recognized in the period they occur, irrespective of whether cash is paid or not. What do we mean by acquired expenses? Accrued expenses from the word accrued, meaning that what? An accrued expenses is a liability on a company. I'll come again. An accrued expenses is a liability on the company, meaning that a company is meant to pay so amount for an expenses last year or last month, and they do not pay, and that period has actually closed. Now we're in a new period. That money is what they are owing. Accrued expenses is the same thing as the expenses owing. That's on that word. Accrued expenses is the same thing as owing expenses or expenses owing. I don't know the right word to use. What I'm saying is just that the money the company is owed as a last period, and now they brought it forward to this period. That is the meaning of that. I hope you understand that. Karim Sulia is saying Aqua 2. What is Aqua 2? I don't get. Aqua, okay, meaning of Aqua. I will just explain meaning of Aqua is the same thing as you saying Aqua expenses. It's something they are owing. So in accounting, there are two terms, there are two words that are being used interwovenly. Aqua and prepayment. Whenever a company has a prepayment, it will serve as an asset for the company. I'll come again. When a company has a prepayment, it is an asset for the company. When a company has an Aqua, it is a liability on the company. Yes, what I'm saying is that when we're talking of prepayment, is a meaning that a service they paid for in which the company is yet to enjoy. You paid for a service and you are yet to enjoy the benefit. You paid for a service, you paid for a rent, for example, and then the company has not used the building at all. They are making it, okay, layman word, they are making a down payment for something. It's a prepayment, prepaid. You are paying in advance, a payment in advance. But when we're talking about Aqua, money you are owing. So that is why in accounting, you always see Aqua under liability and a prepayment under asset. Prepayments are to be debited while Aqua are to be credited. You will soon understand all those. So that's the explanation you are asking for. So not to waste much of our time, someone is asking me that I got it too much. Sorry. Just be writing down, just be jotting. If you have any question, throw it at me. Yes, that's for concept. Can you please explain more on historical costs? Okay, let me put it this way. From the word history, history means something that has happened in the past. When we're talking of historical, when they say something is historical in nature, that is, it has happened in the past. So I'm saying historical costs are those costs of acquisition, the cost you incurred at acquisition. If I may ask, the person that asked this question, looking at your phone, you did not just buy your phone, I'm sure. So you bought your phone last year. For example, let's say you bought you acquired your iPhone 15 last year. Now, the cost of that iPhone 15 last year is an historical cost compared to current cost, because current costs are the present cost of that item. Even in accounting, current costs and present costs are kind of still different again. Present value and current costs are different. That is when we're talking of the costs in accounting. But don't let me divert too much. So historical costs are the costs at the time of acquisition. For example, let's say a company purchased a machinery for 500,000 naira. Even if the market value of a similar machine has increased, when you're using historical cost, the company records the machinery at the original purchase price. I'll come again. Let's say a company, I was using your phone as an example. Let's say you acquire your phone for 500,000. Sorry, you bought your phone for 500,000 last year or last month, for example. Then you now went to the market today, discover that the current market value of that phone has increased to 700,000, and you want to record this thing in your book. You have to record your phone at the initial cost of acquisition, that is the original purchase price. Based on what? Based on history, based on the time you acquire it. If it's now you acquire it, you will record it based on the market value. No. Historical cost, fine, it has happened last year. There's some items like that. You buy them 15 naira today. If you go there tomorrow, you will buy times 5. There's some items like that. So if you want to record in your book, you won't say, no be yesterday I buy now the price where I buy the price they sold this as an item today, I'm going to record it. No, you record based on the historical cost. I hope you understand now. So that's for concept. For convention, okay, convention, write down this. There's something we call small piff. There's something we call small piff. Small piff convention. Convention are laid down rules and regulations that underpin the preparation of financial statement. Small piff. Don't go and write small piff in the exam, or I'm begging you. Don't go and write chapego. This one is for our knowledge sake. I kept saying it too. Don't go and write chapeg. At back of your book, you don't want to forget chapeg. You don't want to forget small people. But inside your answer booklet, don't write small people. Don't be me teach you small people. So the S in small people, are we ready? The S in small people is for what? Can someone guess? I know people have been reading and people have been small. Instead of to spell it, small pif. It just you can decide to change it now. Anyhow, SMOPIF. This is prepayment meant to be credited. I just explained. I said prepayment are assets and assets are debited. That's just the short answer for that. Prepayment I said that was when I said prepayment debited, acquire credit. When you credit something, we'll still come to we'll come to rule of double entry, we'll come to okay. Repayments are meant to be debited, not credited. I hope that clears your question. Yeah, thank you. So for small pif, the first S in small pif means substance, substance over form. Substance like a drug, sometimes over form. The second one is small M, materiality. Materiality. The third one is objectivity. The fourth one is prudence. The fifth one, did I even remember the fifth one? I is for what? Okay, I'll say, let me continue this explanation first. Oh, I want to believe we're following. I know one of them is not meant to be there. Is it I or F? F, no, F is fairness. Yes. F is fairness. Yes. So the I is just for you to have to be able to like pronounce it, or you need a vowel so that it will sound palatable to your hearing. So that's just it. So substance over form. Do you have anyone that has actually heard of the word before? Substance over form. This is to 10. We need to finish chapter 2 so that we can go to the next one. I need someone to just give me something now. This class is too boring today. What's happening? We're going to call names. Yusuf Najat, are you here with us? Or everyone is sleeping already?
We are with you.
It's not about top off.
We are not sleeping.
All right. You said, what do I call F? F is fairness. And then B, you have the Karim. F is fairness. All right. Thank you, Mr. Tokmer. Yusuf Najat. And then be test. All right. Yusuf Najat. Explain substance over form. I'm not saying your layman explanation. I don't need to use ChatGPT. I don't need to Google search. Oh yeah.
Okay.
Do you have any prior knowledge on that?
I don't really have any prior knowledge on accounting substance, but on a layman term, I'll just say when they say something has substance, maybe it has backing structure. I don't know.
All right, nice one. Thank you. Do you have anyone that I want to try? Just one person. Like I just need a person just to try. I'm not saying I don't even need you to get it. Like Najat did. My own understanding is this. So is there anyone before I go into it? She actually tried.
Like
okay,
consumption.
Sir?
Consumption. You need substance. What we consume.
Okay, that's another.
Sir, can I give a try? Can I give a try?
Yes, sir.
Good evening.
Good evening.
Substance over form is just trying to explain those legal principles that govern the accounting presentation.
Thank you.
Based on my own understanding, though.
Thank you, sir. Thank you. Everyone has actually tried. Everyone. And for those that
Hello, good evening, sir.
good evening, Mr. Fahim.
I don't know if I can try. I mean, okay.
You can
Like
try, you
substance
are
over,
already.
all right, substance over form. That is, if
Mhm.
you are prioritizing something over one, there's something over another thing.
That all these things, all these information people are giving, you don't score on it already. All right, thank you for that. I love that. Ajay and Ola raised on the other time, and that will be the last I'm going to take. It has more value. Tokwe, thank you. That's a good one. So all of these things everyone has actually mentioned, sum up together. I'm serious, I'm not joking right now. Everyone has a point. Starting from Mr. Toigo saying that spoke last, saying that when someone has value over another, Mr. Udo said something about you. The only one that I will not take from all the explanation is because I use the word substance, I was just using that to explain, like from the word substance, I'm using that to explain, no explanation, so that you will know how to spell it. Substance. I'm not saying something you consume. Someone said that. That is the only one I'm not going to take. Yes. So substance over form now, if they say substance over form in accounting, means that this principle, substance over form is a principle. We're talking of the convention now. And we said commission are the laid down rules and regulation that guides the underpins preparation of financial statements. So substance over form is one of the principles that emphasizes accounting for transactions based on their real economic situation rather than using legal form. That was when I said economic reality of the economy should be stated rather than. Thank you. Someone just did that. Someone just explained that now in the comment section. So what this is saying is that it's one of the laid out rules and regulations in accounting that emphasizes on what you want to record a transaction. The transaction should be recorded based on accounting principle, rather than you saying, "Oh, this is what the law of Nigeria is saying." No, law of Nigeria does not supersede this when we're talking of accounting presentation. So you should record the transaction based on the real accounting situation, the real economic situation, rather than the legal form. That is what substance over form is saying. I hope someone has actually gotten something. Okay. What this is saying, some people will still want to ask, like, what if the legal structure suggests otherwise? No. This sort of form is saying that you ensure that the financial statements are prepared in accordance with the underlying substance of transaction, economic reality of the transaction, even if the legal structure is saying otherwise. You see, someone is saying no, sir. I don't understand. Please, going to type anything. Please let it be in such a way I understand. Meaning of no, sir. I don't understand. So I'm not going to take that. I don't know that. I don't understand what you mean by no, sir. Do you have a question, or you want me to clarify something, or what? So, Mr. Lucia Kings. So I don't understand your comment. So that is what substance over form is saying. So the next one, do we have any question on substance over form? Is he asking question on substance over form? Because we do not understand. Does it guide not over or not? Okay, you didn't get it because of network. I'll come again. Please, let's stop what's it called like that? The question like that. Let me pick it from the last. Okay, Mr. Lucy again. I'm going to pick that again. I'm saying, like, substance over form. What we mean by that is that this is one of the principles that emphasizes that we should be accounting for transactions based on their economic reality rather than their legal form. As simple as that. Based on their economic reality rather than their legal form. This is to ensure that the financial statements are being prepared in accordance with the underlying economic reality rather than you using legal structure. So that is why in accounting, what the law says, we have it. What is the accounting standard saying about this? Oh, the law is like, oh, for example, now I'm an investor in a company. The legal backing is that an investor will get dividend, right? And investors, or what's it called, will get dividend. They will get their dividend on that. So the company decided not to declare dividend. You cannot say it's legally. The legal structure is that they must declare dividend. No. What is the accounting standard? What does the accounting standard says about this? You want to declare dividend. You can only declare dividend when there is no loss. You cannot declare dividend, and at the end of the day, the dividend you declared actually serve as a major factor in the company declaring a loss. And the consequence of that is that at the end of the day, they will not be able to pay tax to the government. So what is the law saying? What is the accounting standard saying? Most times they don't conflict. They do not conflict most times. But we're saying now, substance over form, they conflict sometimes also. So substance over is that you do the economic reality, the accounting economic reality of the transaction is what you take into consideration and not the legal form. Mr. Lucy, I hope that answers that question. And again, not to draw you back, but what can I say? The guide. Okay, you're saying, does it guide understating profit or overstating profit? When we're talking of understating profit or overstating profit, if the legal form is, no, you can use all these things for so many things. They call it's not even loopholes. No, depending on how you want to structure it, but it doesn't have anything to do with your understating. It might be like, oh, you want to understate your profit by doing this, and the accounting standard does not allow that. You cannot say legal standard allows you. We're talking of accounting standard now. If it's going to lead to understating profit, then the substance will supersede the form. That is, the accounting situation will supersede the legal form of the transaction. And legal form of the transaction, yes. I think there is no other question. So materiality. I'm not even using the material again. So materiality. All these things are in your material also. I choose to be using all this objective and scope. Okay. You see, for those that want to go back or you want to read more, so you can go to your text. You're saying this is going concern acquire. This one, you see, all these things has been listed there. Business entity, substance over form. Although business transactions are usually governed by legal principle, nevertheless, they are accounted for and presented in accordance with their financial substance and reality, and not merely by the legal form. I hope this explains the substance over form that you people are asking for. So those are the basic ones they've listed. So I've listed additional ones. Prudence. Which other one again? So prudence is a concept. What do we mean by the word prudence? Okay, I've opened it. I wanted to ask again. This one actually helps in making caution, like involve caution in financial reporting. That is, ensuring that the financial statement avoid overstating assets or income, or to avoid understating expenses or liability. That is, this focuses on making a reasonable and sensible allowances to reflect uncertainties in business transactions. So, let's see what we have in our text. So, it's a concept which describes the framework will no longer appears. Fine, it no longer appears. Most of these conventions, they are no longer using them. That's why you will see in most texts, historical costs, you might not be seeing them anymore. Which other one did I listed? Objectivity is still relevant. So that doesn't mean you should not list them when they ask you. So we're just saying this one is saying now in the previous version of the framework, but no longer appears. However, approaches used on prudence are found in several standards, so it is important to understand what it means. Financial statement was sometimes recognize the uncertainty in business transaction. For example, if a business is owned 1 million naira by a number of its customers, there will be some uncertainty as to whether all the money will actually be collected. That is, you make a provision, a realizable provision, because the 1 million naira you might not be able to get all the 1 million naira, but that doesn't mean you're not going to get 950,000 naira. You will get, but you're going to make provision now. You're making a provision for or bad debt. It should be a sensible and reliable provision that you're going to make, so that at the end of the day, you will not be understating your revenue or overstating your assets. That's what that is saying. Each other one. This is past 10. Okay, this is what I'm going to do. The rest of the the rest of the convention, fairness is talking about the true and fair, like ensuring the financial statement presents the fairness fairly, that is the true position of the company. I've explained prudence, objectivity. So materiality and objectivity, I want our comment on that, please. It's not an assignment, just type it. Just go and understand it and give me something on it. You don't need to send to me, send to the platform. I'll open the platform after this class because there's no time anymore. So from where we actually move to concept and convention is we're talking about the purpose of conceptual framework, and the first one I gave was it eliminate the inconsistency in the preparation of financial statement, right? So is that the first I gave? Yes. So the other one I'm going to give is it gives proper definition of element. It gives proper definition to element of financial statements. It gives proper definition to elements of financial statement. I hope you're writing that. The reason we're moving around is that all this explanation, there are so many keywords that we need to understand. The first one, when we're talking of consistency, it brings us to concept and convention. So now I just mentioned it gives proper definition to element of financial statement. You should ask me, what are the elements of financial statement? What are the elements of financial statement? Shortly, I'll quickly run through element of financial statement. So element of, we'll see explain because we're still going to meet element of financial statements later. Okay? You're not seeing my screen, okay? Probably your network. Can someone confirm if you can see my screen? Thank you. So element of financial statement. When you're talking of element of financial statement, element of financial statement are, we'll still come across them. So I'm just going to list them. We have assets, we have liability, we have asset liability, we have income, we have expenses, we have equity. Those are the elements of financial statement. So the purpose, one of the purpose of conceptual is saying it gives a proper definition to the element of financial statement, meaning that the conceptual framework, the IASB, they gave a standard definition to all of these things. But I should list all the definition to us now. Okay. Let me just continue with the purpose because time has gone. We'll still come to element of financial statements. Yes, because it's an examinable question. I won't lie to you. So that is that. And that one I'm going to give is that it's strengthening the credibility of financial reporting and the accounting profession in general. Yes, what he's saying is that because we have something that guides the preparation of this thing, it actually strengthens its credibility. People can be reliant, people can rely on the report because there's something guiding it. For example, you are staying in a town where there's rules and regulation. So the citizen or the nationals, their mind will be at rest, like, oh, this thing is a sin if you do it in this city. Whereas, meaning that it's a sin if you do this thing in this our community. Definitely no one will want to do it. We're not expecting anyone to do it. There is to give a level of credibility in financial statement. Because at the end of the day, you say accounting profession is being governed by so many laws, so many regulations. Because they want you to do something that at the end of the day, when an accountant give its opinion on a financial statement of a company, it should be something that the user will put their mind at rest and they'll be comfortable using it to make an informed decision. So that is that. So I said it strengthens the credibility of financial reporting and the accounting profession in general. So the next thing is 1009. Let me quickly run us through the characteristics of using financial information. Then we'll close this chapter. I'll give us as an assignment. I'll run us through it, and the ones I was not able to touch will be an assignment to us. So, qualitative characteristics of a useful financial statement. Qualitative characteristics of a useful financial statement. I hope you're writing down. Qualitative characteristics are in two ways. They are divided into two. We have something we call enhanced characteristics. And we also have fundamental comes first, fundamental characteristics, and we have enhanced characteristics. When we're talking of fundamental characteristics, what do you mean by fundamental characteristics of a useful financial information? That is, before you can say financial information or accounting information is a useful word, there are some characteristics, there are some attributes expected of that financial information to have, of that financial accounting statement to have. What are the fundamental ones? Fundamental qualitative characteristics include number one. For fundamental, I'm talking about now. Fundamental, we only have two fundamental. We only have two fundamental, and we have two fundamental, and we have I think 3 or 4 enhanced. One fundamental is relevant, and 2 is faithful representation. Number 1 is relevance, and number 2 is faithful representation. What do we mean by relevant and faithful? These two are the fundamental qualitative characteristics of a useful financial statement. When we're talking of relevance, that is information, the financial information must be relevant to the decision makers or the users of the financial information. You cannot just pack a jargon. You cannot decide to pack jargon and expect the user to understand what you've actually. So any information you'll be giving to the management, to the users, to the investors, to the analysts, to the management, to the creditors, to the customers, who other users do we have? So many of them. Please, the cap number 3. So many of them, those information must be relevant to their needs. Okay. There's something in economics that we always I remember then they explained something to us that the difference between want and need. Yes, your want is something you actually wish to have, while your need is something you need for survival. So when we're talking of users, we know all the users of financial information. So any information you are giving to them must be something they need, something that will add value to the problem at hand, something that will help them in solving the management problem. No, it's a normal thing for them to want. We want all this information. But which one do we need? We need the statement of financial position as at 2024, showing the total value of our assets and the total value of our liability, because the management wants to decide on how well we've been able to use the assets of the company to generate revenue, or in order to ensure all those things are what they need. Relevancy, we need it. Is it relevant? This information you've given us, is it relevant to the problem we want to solve? That's the question. So the fundamental characteristic of a useful financial system is that, number one, it must be relevant to the need of the users, to the need of the management. Management is one of the users. So to the need of the users of the financial information. As simple as that. You can buttress it any way you want to explain it. Someone is asking me like, the tap number 3. What is number 3? Okay, number 3 of the, which one did I just give just now? So one thing is that most of these things are just coming to my head. I have to just drop them. I know it's about, okay, I said it's strengthening the credibility. I'm not talking of relevance or now. I'm recapping number 3 of the purpose of conceptual framework. I said it strengthens the credibility of the financial statement. That was what I said for number 3. It strengthens the credibility of financial statement. So relevance is saying that financial information, a useful financial information, must be relevant to the users. So when we're not, number 2 is what? Faithful. Sorry, I wanted to write. It's faithful, not faith. Faithful representation. Faithful representation. From the word representation. That is, the financial information must represent faithfully the position of the business entity. That is, if you claim that the company actually makes a profit of 1 billion naira, what you are having in your statement is showing, in the financial information is showing, oh, this company has made 1 billion naira. It must represent faithfully and fairly. That is, the true and fair view of the financial information. True and fair view. You must not be biased with whatever information you are giving them. It must represent it faithfully that the company makes 1 billion naira. In actual sense, they made 1 billion naira. That is what he's saying. Faithful representation. That is why you are faithful to your boyfriend or your girlfriend. It's faithfulness. From the word faithful, representation. You are representing us. Whatever information you have there must represent the true position of the business entity. That is what faithful representation is saying. I don't take anyone will have question on that. Any question on that? Number 3 again. Just give me one. Okay, it has been long. Okay, faithful representation is saying a company must represent faithfully the economic reality. If you claim that you have so receivable of 10 billion, it must be so. Eventually, at the end of the day, when they ask you, this your receivable means debtors. Those people are owing you. They are owing you. You have people owing you the amount of 10 million actually. So give us their names. You can go to them, do a circularization to them. Let's do a reconciliation. And in the actual sense, they are actually owing you 10 billion naira. It's as simple as that. Showing faithfully what the reality or the real economic situation of the company is. So that is the fundamental characteristics. Now we now come to enhance characteristics. That's one number 3. Fundamental characteristics is one on its own. We have 2 under its relevance and faithful representation. Why enhanced characteristics? From the word enhance, they say when they say something is enhancing something is adding value. Something is adding value to something. You are adding value. That is, the rest of these characteristics we're going to mention now, they are adding value to the fundamental ones. So what are they? What are the enhancing ones? The enhancing one includes number 1, comparability. This class must end by 10:30. Comparability. Number 2, we have what again? Verifiability. Verifiability from the word verifiability. We have timeliness. I want to believe someone is writing something. We have timeliness. What again do we have? We have comparability. All right, thank you. Comparability. It should be one. Okay, understandability. All these ones are self-explanatory. I believe it's something we can. I think this one is 4. Yes. Please, if you've read it before, okay, I should open the material. So, understand. Oh yeah, ask your question, Mr. Adeshop Babakari. Adeshop Babakari, you have the floor. You can ask your question, sir. Okay. Okay, since you don't have any question, so the answer consistency is saying number one that I put down here is comparability. You see, this what we mean by comparability is that is the user of the financial information. You know, all these things are what are the qualitative characteristics of a useful. That is, you say something is useful. These are the attributes expected of them to have. So when we now say one of them is comparability, that is, the user should be able to identify and understand the similarities and differences when comparing financial information of other entities or comparing a particular period with another. If you've seen a financial statement before, you have anyone up? I should have. Surely. If you've seen a financial statement before and one published, you go and download anything you see, you will see that there's always a comparative year. If you see 2022, you will see 2023. I don't even have anyone open in my book on my laptop. Should I just do that? This one's I'm about to open. I should have now. Okay. Okay. This is a company, for example. This is a company, for example. You are seeing two figures here. You're seeing two figures. This is 2023. This is 2023. This is 2022. That is what comparability. For comparison's sake, the company will put a comparative year in such a way that the user will be able to compare. Oh, last year, sorry, I could not. Reliability. What about reliability? Yes, it's still part of it. Thank you. So I could not open that financial statement. It should be confidential. Sorry. Yeah. So as I was saying, the user should be able to check. Oh, in 2022, you said your turnover was 2 million. Why is it now 500,000 in this year? What happened? Oh, it's because of COVID-19. So operation has not been smooth. Stuff like that. Oh, you have huge profit this time around. What changed? What strategy do you use this time? Oh, we employ skilled personnel. Our marketers have to go back and forth. Our marketers have to do the undone. They have to do this. They have to do that. So all those things, they are the metrics. They are the factor that influences our revenue. That influences the increment in our revenue. So comparability, well, you'll be able to compare this year with that year. And this year with this. Oh, this is a company that we're in the same industry. How are they performing? Let's compare. How are they doing? Oh, my name is Amity Cement. Oh, I want to compare my business operation with Boa Cement. Then financial statement of Boa Cement, compare with my own. What am I not doing right? Why is making 1 billion naira? Now I'm making 32 million naira. This is not enough. What am I not doing right? What are they doing above me? That is for comparability. So a used financial statement must have a comparative year. You must be able to compare it. The user must be able to identify and understand the similarities and differences when comparing the financial information of either other entities or a particular period with another. So the third one is verifiability. From the word verifiable or verification. The user of financial information must be able to verify the information presented on the face of the financial statement. That is, the user must be able to verify. Oh, you claim that you have PPE of 10 billion. Can I see them? PPE are your property, plant, and equipment. Oh, and you take them to where you keep the generator. This is a generator that was 5 billion, and it's what it actually. We have 32 computers, and they counted them there 32. They were able to verify all the information on the financial statement. So that is that about which other one? Timeliness. That is, this is timely. What this means is that it must be timely. I need an information. I need an information for a board meeting that will be happening tomorrow. You are now telling me that this information will not be ready until next month. It's not timely. That is, the financial information must be timely to be able to influence and to be of use to the users. I need information on how well this company is performing before I can invest. I wanted to invest. You're not telling me that the financial information is not available and I want to invest. Is it timely? You're telling me it will be available next month and I want to invest now. It's not timely. So the financial information must be timely to be of use, to be relevant to the users of the financial information. Understandability. From the word understanding, information that will be presented on the financial statement must be presented in a manner that is clear and concise. A clear, unambiguous information. You don't use financial jargons, accounting jargons. We have jargons in accounting. Jargons doesn't mean something bad. They are just words that are only understood by the professionals. Sorry. For doctors now, they have their own financial jargons. They have their own jargons. They are just terms that relate to that profession. So accountant has their own. So but accountants jargons now are going viral. I don't want to be a liability, and you do. What liability is an English word, you know? It's an accounting term. So it goes on like that, and goes. So someone said like, reliability. That's another one. Reliability in the sense that the user must be able to rely. They must be able to rely on whatever information you are giving them. They must be able to rely on it. So that is for accounting. What are we doing? Qualitative characteristics of a useful financial statement. Yes, that is the qualitative characteristics of a useful financial statement. For that, materiality. I said I gave us the materiality as assignment. I'm not saying you should submit. Just go and understand it. So the next thing I want to pinpoint is, okay, we've done all this. Thank God. If you have any question, just drop it. We have 4 to 5 minutes. So what is meant by fair presentation? From the word fairness. When we're talking of fair presentation in accounting, it means that the financial statement must portray the true and fair view. That is, must show the true and fair view of the financial, of the position of the entity. That is, information you're going to present must be fair to represent faithfully, fairly, what the position of the company actually is. So this one is saying what is meant by fair presentation or a true and fair view. Financial statements are often described as showing a true and fair view or presenting fairly the financial position and performance of an entity and changes in its financial position. So meaning that the financial position of the entity must show faithfully what the position of the entity is as at that period. If we claim they have this, they should have it. If they claim they are holding it, they should be holding it. That is what this is saying. So that is all what they're explaining here. And let's do our chapter review before I open the floor for questions. I know all this theory. Sorry, yeah, we're coming to calculation. But let's do it. To be done. Okay, we've explained the meaning of gap. We've described the purpose of IAS conceptual framework. We describe users and information needs. We've done that yesterday. This is chapter 2 review. So state the objective of financial statement. We've done that. We describe the qualitative characteristics of financial information. Element of financial statements. I only listed them. I didn't define them. We're still coming to that. Okay, they were the one I give us an example. Okay, now as an assignment, please, we've listed the elements of financial statement. I'm going to list them again. Number 1 is assets. Number 2 is liability. Number 3 is income. Number 4 is expenses. Number 5 is equity. So you have to give me the definition of each of these elements. Mind you, when you're giving me the definition of elements, if you go on Google search, I will know. Because I want the definition in accordance with IAS standard. I gave explanation of assets yesterday. I gave the one for liability. I didn't give for expenses and income and equity. So I know I've given 2, at least. Let me see your understanding on that. For the one you're going to give me, if you Google search, just make sure you understand it. I don't have a problem with that. Just make sure you understand it. Understand what you're giving out and read it. It doesn't make sense if you Google search and at the end of the day, you were asked to explain and you're not able to. Yeah, and once you grab all this elementary stage now, when you're preparing for exam, you just do something like a brush up, like let me just review, let me just recap. It will be something you've known or you understand before, you've understood, so you don't need to like, oh, I need to read this, I need to read this again. So that's that about elements. So now, recognition criteria of elements in financial statement. I think this is the only thing I've not touched. Share presentation has been touched. Materiality of certain consistency, we've touched materiality, we've touched consistency. Offsetting, add it to your assignment, explain. Offsetting is just using one thing to net off another. So that's just that. That is using, someone is owing, offset, the word offset. Use this to cancel off this. 2 divided by 2, 1. 1 minus 1, 0. That's the mathematical aspect of that. So accounting has offsetting also. Explain that. So the last one I would want to explain, just 2. Okay. In 2 minutes, I'm going to explain this and I'll open the floor for question. Please don't ask me the question of the assignment. Sorry, don't ask me the question I give you as an assignment. I don't want that. So that I won't go and explain and you'll be putting down that again. So recognition criteria states the recognition criteria for elements of financial statement. We have the elements already, we know them. So what are the recognition criteria? Firstly, what do you mean by recognition criteria? These are the criteria that before you can classify an asset, before you can classify an element, they must meet this criteria. Before you can say something is an asset, they must have met this criteria. Something is a liability, they actually met this criteria. Something is an income, they met this criteria. Something is an expense. What are these criteria? Recognition, we're talking about recognition, is the process of you capturing an item or element for inclusion in the financial statement. That is, before you can capture an item or an element for us to include them in the financial statement, they must, what are those criteria they need to meet? That is the meaning of recognition criteria. So recognition criteria include, number 1, they said number 1 is sorry, let me try. Okay, recognition, what we're talking about, number 1 is for us to classify an asset, they must meet the definition of an asset. That is, they must meet the definition of an asset, a liability, or equity before they can be recognized in statement of financial position. You know, statement of financial position is one that has assets, liability, and equity. So before we can classify them, or before we can include them there, they must meet the definition of an asset, the definition of a liability, the definition of equity. And I've given us the assignment of definition of asset, liability, and equity. So I will see how we want to answer this one. Okay. That's number 1. Number 2 is that they must meet the definition of income and expenses. You know, income and expenses are what we use in statement of profit or loss. Why asset, liability, and equity are something we use in financial position, meaning that before we can recognize them as an item in financial position, they must have met the definition of an asset or liability or equity. For measure of financial, measure of profit or loss, they must have made the definition of income or expenses. So, what are now the recognition criteria of an asset or liability? So, that is where the definition comes in. Number one, they meet the definition of an element, that is, definition of an asset or liability. Number two, they must satisfy the following. Number two, they must satisfy the following. See, I'm not going to type now. What about completeness? If you want to add completeness, fine. Even reliability, I've said it, if you want to add it, fine. So many things have changed over the years. If you want to add it, fine. It's not going to reduce your mark. Yes. So, when we're talking about recognition criteria, I only have recognition criteria. It's so funny how we have more than 100 people that started this class. Okay. Recognition criteria for assets or liability. Number one is that they must meet the definition of an asset or liability. Let's say it meets, before you classify, it meets the definition of an item or element. By elements, that is assets or liability. Number two, they must satisfy the following. This is why I wanted to type. They must satisfy the following. Or it must, because the two of them cannot at the same time. It must satisfy the following. Number one, it must be probable that the future economic benefits associated with the item will either flow in or out of the entity. Sorry, I'm going to type that. It must be probable. It must be probable that the future economic benefit, will flow in or out of the entity. What does this mean? Before you can classify an item, that is, it must be probable. When something is probable, that it must be assured that the future economic benefit, what are the economic benefits saying? That is, there could be a gain. Future economic benefit, that is, economic benefit is still money, or whatever that what increases their efficiency in the terms of what economic benefits. Economic benefits, we can call it money, we can call it goodwill, all those things. So that it is probable that this transaction you are entering into, this asset you wanted to buy, this as a transaction of liability, it is probable that future economic benefit will flow in. That is either it's flowing, that is, it's an addition to them, or out of the entity, or it's a liability to them. That is how you classify a liability. Oh, I'm engaging into a transaction. I and Najat, we are signing a contract. This contract to me will lead to an inflow. That is, it is probable that this inflow, that is, Najat is selling a piece of land to me. Okay, sorry. I'm selling a piece of land to Najat. You know, I'm the one selling. What am I getting? I'm getting money. I'm getting economic benefits from Najat. She's paying me. To Najat, what is she getting? Out of the entity, she's paying. But in the long run, in the future, economic benefit will flow in because that land will appreciate. So you'll be like, oh, this land is going to appreciate. Economic benefit will now flow into my own money. So I will be less assured like something is coming into my bank account at the end of the day. Because I have a land that can sell. It's a future, probable that future economic benefit will flow in as a sort of a transaction I engage with Najat. Are we together? So that means it's an asset too. So same as liability. I engage into a transaction that I know I'm going to pay a debt. I'm going to pay an obligation. It's a liability. So that is one. Number two is that this liability that we're saying, this asset we're saying, it must be able to be measured reliably or reliable, anyone. That is, the item should be able to be measured reliably in the sense that you cannot say, okay, this is a land. The future economic benefits will flow in. How much is flowing in? We must know that the item should have a cost or value that can be measured reliable. The item or the element that we want to classify. You cannot classify the land without value. There must be a cost. The item or relevant must have a cost. Or what? Or value that you can measure. That can be measured reliably. So this is the recognition criteria. Are we together? So let's check material, what they have for us. Okay, that's chapter 2. Thank God. Recognition criteria. Okay, so he's saying only item that means, okay, so we don't know this. This is not what I'm looking for. Okay, see, number one, under the previous principle, asset must be recognized when it meets the definition of an element or item. We've done this, we've said this. Satisfy the following two criteria. It must be probable that the future economic benefit associated with the item will either flow in, anyhow they put it. What they're saying is that it's either this transaction leads to an inflow to you or an outflow. Number two is that it must have a value that can be measured reliably. What is that? About that. So this is where we come to the end of this class. And I'll be opening the comment section, or I'll be opening chat for questions. Who is this that has been raising hand since? Yeah, thank you everyone. Thank you for your time. Thank you for your audience. Thank you for your sanity and everything. It meant a lot. At least no one is disturbing the class, and we don't have a cause to remove anyone. I'll welcome question in the next for the next 4 minutes. Thank you. Let me also thumb up for you guys. All right, so what are the questions that you guys have? Let's be thumping up to ourselves. Oh yeah, now any question? I want to believe we understand everything. Yeah, I always have questions. If you guys are not asking questions, I can decide to give you an assignment. Yeah, no question. All right. I assume that we understand everything, and we actually have everything in our book, at least. And if you miss any part, you can easily go back to the YouTube video. You can go back to the site and watch the aspect you missed. You need me to clarify something, you can enter my DM. I'm always free. I'm not always free. Or enter my DM and send me whatever information you need me to clarify for you. And another thing, please do not limit yourself to this class. You can read ahead. It's free. It's a free word. Overtaking is allowed. Overtake your tutor. Please read ahead. Always get prepared for exam. Thank you for your time. Thank you. I remain your professional colleague, Akiade Afis. Thank you, everyone. Thank you. Bye for now.
Thank you. Thank you so much. Thank you.
Thank you, sir.
Thank
Bye.
you. Thank you. God bless you.